Climate change, carbon pricing, government regulations. Those are words that strike fear into the hearts of the resource extraction companies that form a huge part of the Canadian economy. Climate change has made the future risky for all of us. This cannot be understated. In the resource extraction industries, particularly oil and gas, these risks have financial consequences. Who wants to lend money to a company that may be forced to go out of business if public opinion and government policy shift away from fossil fuels? Climate risk becomes credit risk. Olaf Weber, the CIBC Chair in Sustainable Finance at the Schulich School of Business, has some new research to share on this topic. My interview with Olaf is up next. Olaf, welcome to the podcast.
Hello, thanks for having me.
Could I get you to introduce yourself to our audience?
Yes, sure. So my name is Olaf Weber. I am the CIBC Chair in Sustainable Finance at the Schulich School of Business. And just today, I got all the congratulations for my first year at Schulich. So it's 1 year ago that I started. I'm in the sustainability area, sustainability department, and still a bit connected to Waterloo, where I came from, the University of Waterloo. I have still some grad students there that I supervise. And my area of specialization, as the title says, is sustainable finance. So I address financial risks in the credit industry, so credit risks that are caused by sustainability issues, for instance, by climate change. But I started very early, by contaminated sites and things like that. So the earlier environmental risks, and so I'm doing that since some decades already, focusing on credit risk, but also investment risks and opportunities as well. The use of ESG, environmental, social, and governance indicators for investments and credit risk decisions, and so on. And so I'm generally interested. How can we make the financial industry more sustainable or address sustainable development in a better way than do now? Not saying that they are not good at doing it so far, but there's always room for improvement.
I'm going to ask you the question about which came first, the chicken or the egg. Did you get interested in sustainability first, or were you mainly interested in credit risk first?
Very good question. So I'm coming from a risk management perspective in general. And so at the time when I started, I looked for cases in a way where I could apply my knowledge and the research as well. And there were two at that time. One was credit risk. The other one was environmental risk. The nice thing is, in these two types of risks, you know what the positive and negative outcomes are. Credit can be default or not, or there you have an environmental risk like a contamination that has a negative impact or not. And so, to be honest, in the beginning, I thought it's quite independent from each other. But then, especially, it was kind of in the mid-1990s, because of new environmental regulations, especially, both were connected. So when we had no environmental regulations, contaminating a piece of land didn't have any consequences. After the introduction of certain regulations, it had consequences because you had to clean up the land. And then in case you are a lender and you have this land as collateral and you want to sell it, you got in trouble. And so, it wasn't really planned to get into that. But it was a coincidence in a way, that we had new regulations, new guidelines addressing environmental issues that affected the financial industry as well.
Now, you've got a paper that just came out in 2023, and you've got another paper that's under review that more or less go together. Can you describe what these studies are about?
Yes, we want to figure out what is the effect of an emission price. So if you price greenhouse gas emissions, what we do in Canada, what we do in many other countries as well, what is the cost effect of that? And if there's a cost effect for companies, then there's an effect on the credit risk of these companies as well. pretty straightforward. If you have higher costs, then you have less money to pay back your loan, and so you have a higher risk. And so this was the kind of starting point to see, okay, can we figure out what these costs might be? And so we started from with the Canadian sample at TSX 260 and used the carbon pricing scenarios that we have in Canada, that should go up until 2030 to 180 Canadian dollars per ton. So we are much lower now, but that's the plan. And that's not long. It's not a long time frame. And so we wanted to figure out, okay, given different costs per tons of emissions, what is the impact on the costs? And so we used a standard credit model, Altman Z-score. That's pretty easy model that's applied a lot. And we factored in the carbon costs as costs in the different indicators in this model. So the EBITDA has a cost factor, for instance. And so then we calculated what is the impact on the Z-score, that is the total credit risk. And so that was the approach. And so we did that for Canada first, and then now we are currently doing that for emerging countries as well, because it's an important question there as well. What is a bit different in the international study is that we use different scenarios of climate pricing, because we know that not all countries have the same climate price. So we have to figure out what's the plan there. And so we try to model that as well and try to model the costs for the companies as well, depending on their emissions.
Does your study take into account shifts in capital flowing from one country to another, depending on the differences in carbon pricing?
Not yet. So we used, to be honest, a relatively simple model, so really focusing on per company, what would be the costs. And as I said, it's very simple. You could also argue the question is, are these really costs, or would the companies be able to let the clients pay for the emissions, for instance? And so these are things that we might address in the future to get a better model on that. Mm-hmm. But we focused on the kind of domestic risks.
So if I understand it, and please correct me if I'm oversimplifying here, you're looking at a driver, which is the level of carbon pricing that is imposed by government policy, mm-hmm. and its effect on the credit risk of these companies. And then what? If the credit risk changes, what's supposed to happen next in the company?
Yeah. So, the thing then is for the lender, what do we do now? And so there might be a change. If you are in the middle of the pack, you might have a slightly higher risk because of the costs, but this might not be really a threat for your lender, or it doesn't change a lot or a bit, but you are good as well. So if you're a company in good standing, in a way, you can afford to emit more if you can afford the costs. The interesting case is that high emitting industries often have pretty high credit risk already. And so that's, for me, kind of the most, let's say, scary result of that. So if we see, especially the oil and gas fossil fuel industry is very capital intensive. They have a lot of debt, and there's the risk, and if then you have higher costs because the emissions, and they have high emissions usually, then you have a kind of interaction between an already relatively high credit risk plus additional costs. And this is something, regulators or the financial industry should keep in mind and consider, that high emitting industries are often industries that have relatively high credit risks already. So it's not that they, make a lot of money and they can take it easy, but it's the question, how can I address that? And do I run into a systemic issue then? If you have a look at Canada with a pretty strong fossil fuel industry, this might really have a big effect. But let's see, in our international study, we have countries like Nigeria and others that have even a higher dependency on the industry. And so there might also be issues then internationally that certain countries really get in trouble if they improve a carbon price, what many see as the solution to the problem.
Just to clarify, when you're talking about lenders evaluating the credit risk of these companies, are you talking about regulated banks? Are you talking about the bond markets or what?
It's both. The model we use is typically a model that is used by banks, commercial lending. And so that's what we do there. But it's similar. There are other studies that used other credit risk models that are in a way similar. So you can use that for bonds as well, the bond market. You can use that for commercial lending and other types of lending, project finance probably as well. But the costs are usually in these models, and you can consider the costs in the models and then see what the final risk, the risk outcome is.
Right. Now, in the 2023 paper, you've got a graph in figure 1 that caught my eye because it shows the greenhouse gas emissions in Canada over the years. And it starts in way back in 2010. It goes through to 2020. And I noticed that in 2020, the greenhouse gas emissions in Canada dropped below 700 megatons of carbon dioxide equivalent for the first time in years and years and years. Is that evidence that government policies are working, or is that just random?
2020 is COVID was had an impact.
That's what it is.
So we know that went down, in Canada and everywhere. Generally, environmental pollution, of course. I think it was the first time where you could swim in the Ganges again. So that was a reason. It's going. I think the newest data said that it's going down in Canada as well. However, it's not going down in the Canadian fossil fuel industry. That's the bad news. Okay. The good news is that we still managed to decrease it. But it's also, so that's the first time, I think, this year that it's going down without having such an external impact, like COVID.
So what did you learn from the study that would apply to the banking industry, and what did you learn that might apply to policymakers?
Yeah, so for the banking industry, definitely consider these types of risks and also consider the interaction with the credit risk that it's already there. And so that's important. And also, I would say it's not only the cost for carbon emissions. If you look at Canada, that might be also cost for carbon capture and storage if they follow, if the company follow that route, but it won't be free. I think we can say, okay, if you want to reduce emissions, it's never free. And so you need to figure out how you can do that. So I think that's from a banking perspective to address these risks. I think most of them already do that. The question is how long-term do they do that? Especially in the lending industry, there's always this argument. A typical loan is 5 years. So what? We can go out after 5 years, but that's not real. If you look at the industry in Canada, for instance, the banks have longer business connections to their clients than just 5 years. And if that whole, these connections would break, then they would get in trouble. So that's from the banks, do a thorough risk assessment. From a policy perspective as well, to see what are the consequences, the economic consequences of different models. We have a huge discussion. What is the effect of the climate pricing on the consumers now? Well, that's the topic, the current political topic. But, we should also think about what are the consequences for the industry and how can we transition industries without creating economic turbulences, and I think this is something where we try, where we try to develop policies currently to address these things. And nobody wants to have a whole sector in turbulence and then kind of affect the financial industry as well. And so we have to think about how can we can we create these types of regulations and maybe also support other, using subsidies or something otherwise to support transition process without creating big economic turmoil.
Mm-hmm. I'm going to ask an impudent question, if you don't mind. I can see one possible outcome of this study would be that the banks would look at it and say, well, we really need to put pressure on the oil companies to reduce their carbon footprint. Isn't it possible that they turn around and put pressure on government not to raise carbon prices?
Yeah, I would say, of course, I would prefer the first, but the second still has to. So if you say just, scrap all kind of policies that address carbon emissions, you will have costs anyway in the future, because then we have the negative effects of climate change. And this usually studies show that this is much higher than the investments we can take now. So if we say, okay, we introduce a climate price, and if it's really successful and brings down the emissions, then it's cheaper than dealing with the issues later. The second question is whether the industry is really only influenced domestically. Let's see, most of the exports go to the US. And if let's say the US starts to address emissions and says, you have to pay a border tax on emissions or something like that, what is possible, the European Union thinks about that, then the industry will be affected anyway. And if you have too high emissions in your product, you can't export it anymore. And this has a negative effect on the lender as well. So I would not, recommend to put pressure on relaxing the policies, but rather to say, okay, what are ways that we can guarantee a long-term transition that doesn't put too high risks on us?
Mm-hmm. So we have this nexus of environmental issues, finance issues, and the time horizon, which is, varies depending on what kind of decision people are making. Can you tell me a little bit more about this notion of time? You discussed it briefly when you said that banks had hypothetically a 5-year time horizon, but tell me more about this.
Right. So that is an argument that's often used. We have usually the contract of a loan is 5 years and climate change is a longer term. And if we realize that there's something happening, we can still finish the contract. But overall, that means, of course, that in 5 years, if it's really higher risk, you can't do any new business anymore with them, or kind of, extend the contract because the risk is so high. So you don't want to have that. So it's not really an argument. And what you see, that's the interesting thing on the long run. If you look at pension funds, for instance, or other institutional investors, they look at that in the long run and they see it as well. And so they are afraid that especially if they have direct investments, it might be in the industry or even in other investments like agriculture, forestry. If you don't know what's going on in 20 years with the timber, with the forest that I have invested in, then you really get in trouble. So, and I think this is important. You have these kind of direct risks that depend on the duration and all these things that make sense, of course, if you assess these risks. But overall, from a systemic point of view, it probably makes more sense to have a more long-term view on these things. You can bank on it, saying, okay, now the next 5 years I go full speed, And there was some criticism about that the bank did it, but it's probably, from a long-term perspective. And if we want to keep the stability of the financial industry, what is a kind of strength of the Canadian economy, then we should definitely, address the problem.
Yeah, well, I mean, the banking industry in Canada is very heavily regulated compared to some other countries. Yeah. And our oil industry is somewhat regulated as well. I don't know whether it's as heavily regulated. But when you're talking about the regulations in the banking sector in particular, Do the banks tend to have a longer time horizon or a shorter time horizon than the bond markets? You mentioned these institutional investors who I presume are picking up a lot of the bonds.
Mhm.
So is there a difference there?
In the bond market, it's probably a bit more long-term than in just commercial credit. But banks are involved in the bond market as well. They are involved in project finance and other global equity investments as well. And this is a more long-term view. Our example is from commercial lending. But I think, at the end, you can do very similar studies on other types of financing and probably find similar results as well. So you have the cost factor anyway. And, what is the alternative is maybe then you just really go per year and see what is the carbon price this year, next year, this year, how long can I afford to do that? That's, of course, that's from a pure risk perspective. That's something. But what you do generally, if you want to, if you address the financial stability of a bank or of the industry, you check their whole portfolio and you want to see, okay, how much are they exposed to these types of risks? And then you have different types of products and services. Some are more long-term, some are more short-term. So, but there are differences.
Mm-hmm. Now, I don't think your paper looked at this specifically, but I'll ask you this question based on your own experience. We're living in a time where we've seen interest rates go up and they're starting to come back down a little bit. Did changes in interest rate affect the credit risk? And how do higher interest rates amplify what you're seeing?
Yeah, of course. There was an interaction as well. If you have a very low interest rate, then overall you have less costs as a borrower. And then you are better off, And then again, if you have an interaction here, if you have increasing interest rates plus increasing costs for carbon emissions, then it increases the risk as well, And then think about maybe you have less sales as well, And so things can amplify quite quickly then.
So does this mean that higher interest rates are climate positive?
That's the argument of the divestment movement, for instance. They say, okay, we divest, we sell. That means that the value of the shares of the equity decreases, and this will increase the interest rate because the risk, of the company increases. And that's what they bank on. And they said, okay, if we have higher interest rates, then the fossil fuel industry cannot invest as much anymore into new sources, for instance. But that's the same. If the interest rate is high, then the industry has less capital to explore new sources, for instance. And so, that has definitely an effect. And higher interest rate will probably lead to lower fossil fuel output.
Do you get a chance to build your current research into some of the courses that you teach?
Yeah, I do. We discuss in the sustainability and business course, what is the cost factor of sustainability? If you have a better performance, does that increase the cost? Does it decrease the costs? How, what does it say about the company's risk? So that's a part of that. I discuss generally sustainable finance in a way with the students. I'm also developing a new course on addressing sustainability in the financial industries. And so this will be definitely a topic there. The question, how do they address these issues? How do they address climate change? But I think the interesting thing here is, especially for students that do not have the sustainability perspective, that they see that sustainability is pretty material. It's nothing like a nice to have, kind of tree hugging thing. It's, if you don't care, and let's say if you don't check your emissions, if you don't decrease your emissions, you get in financial trouble. So it should be a part of the costs of projects, for instance. So if you have an oil field there should be, assets that are used to clean it up at the end. So, in a way, whether they really do it or not, there is regulations that they have to have it. So it has an effect on the cost as well then, because you have to take some money and to put it there, what is very long term. And of course, nobody likes to do that. Who wants to put the assets to wait for 30 years to maybe being used then? And so, there is an effect of other things as well. There might be also, issues if there were, contaminations of water or land or something, and they had to pay, immediately or something like that. So there are definitely other issues as well. And that's not only, of course, in the energy industry, that's for other industries as well. So, but in general, environmental costs play a role, and it depends on the industry, but, lenders or investors should definitely assess them. And there are mechanisms in place to do so.
There's one phrase that you used that I just wasn't sure about, because you said one of the implications of your paper is that lenders should start to take these, or you didn't use the word start, you said lenders should take these risks into account. Are they not already taking these into account?
Mostly they do. The question is, what is the detail? What do they do? And so I think, since probably 10, 20 years, they address environmental risk or other sustainability risks. It's still not really, let's say, very integrated in the models. Think about, rather than you have someone in a bank addressing environmental issues and do the assessment, and someone else does the financial assessment, and then they try to put that together in a way. So it's not that they don't consider that. And there are studies from the banks as well. How risky is it to lend to the fossil fuel and see what is the impact of climate change and all these things, but it's definitely something, what I would say, also working with scenarios and with pretty, with the climate pricing that kind of comes from that. And maybe also, thinking about what are additional costs. Let's say, if there's no climate pricing, if there are effects on the industry. I think that came back as well, right? With the fires, they had to try and make sure that the oil fields do not get affected. So these are effects as well. And so they do it, but I think there's always room for improvement, and then they should do, should really try and develop financial or quantitative models that address the problem.
It's interesting how these rational models intersect with emotional models.
Yeah.
And I wonder if there was any change in thinking in the fossil fuel companies, any change in thinking in the the credit industry around, say, the Fort McMurray fire, which was, this human-caused climate change effect hitting directly at the what we used to call the tar sands.
But it seems for some it works, for others don't. I think there was in the news on it, and it was the first thing I thought. Okay, kind of the empire strikes back. You have the emissions, and now you are affected by that. But I think many of the reactions didn't even think about that. And so, I think it's still very hard to explain this connection. You do something, you emit, and in a way you could argue, okay, what are the ratio of, Canadian fossil fuel emissions compared to the world's emissions is relatively small. You can argue like that, and no matter what they do, they will be affected. But it's on the other hand,
we're punching above our weight in terms of emitting greenhouse gases.
Right. But I think I always find it interesting, that this kind of emotional model or the emotional connection doesn't does not work as we think it does. I think it's changing slowly, I believe, but it's still, it's still hard to, for people to understand. I had a conversation with someone, and she said, I'm from whatever in rural Saskatchewan, and they don't understand why we should subsidize rich people to drive a Tesla. And my thinking was, because even I benefit if someone else drives a Tesla instead of a fuel combustion engine car.
Yeah.
Because it has less emissions, that I benefit from that. And I think it's hard, that people, still don't have these connections between.
Well, it also shows an ignorance for how the fossil fuel industry is subsidized in Canada.
Sure, of course, but you have it similar, I'm from Germany originally, and that's pretty similar there. You can argue as well, they have the automobile industry is subsidized there. But, it's hard for many people to understand that something, that can originate from somewhere else, but still affects me. And it's not that I'm always the person who has to do that. It's good if we do, but if others do, it benefits us as well. And so that's something that's hard to understand, this indirect effect.
Do you teach any undergrad courses?
Not yet.
Not yet. Okay.
Not
so
yet.
I was going to ask you if you noticed differences in the new generation of students coming through with respect to climate change.
I taught environment and business in an environment and business program, and even just the amount of students was surprising that do that. We had 120, 160 students per year. So there's an interest, and what I see also from the in the MBA that I did, the courses, I was surprised how students really understand that and how concerned they are. Well, I changed from a faculty of environment to business, and of course, what my thinking was, okay, now I have to convince everybody that sustainability makes sense, but it wasn't like that. I think there is a good, understanding and that we need to integrate these things into our business decisions.
Yeah. Well, it's research like this that gives our students things they can do.
Yeah.
Right.
Yeah.
In their role as business leaders.
Right. And that's kind of, I think on the one hand, it's nice if we can educate, those that will work in sustainable business directly later, let's say whatever, head of sustainable finance. But I'm kind of, in a way, more interested that everybody knows something about it. No matter where you're working, if you are, as an accountant, whatever, as a risk manager, wherever you work later, I think everybody should, have some sustainability or sustainable business knowledge that is more than just, an attitude. So I think,
exactly.
We need some background knowledge about that. And if someone, who does global equity, global investments, sometimes thinks, from a sustainability perspective, maybe we shouldn't, or we should modify things. I think that's something I'm striving for.
Thank you, Olaf, for taking the time to explain this research to me. It's interesting to see you tackling a topic that is based on such huge portions of the Canadian economy. The resource sector and the finance sector are big pillars of the Canadian economy. And to see you tease out the interactions between them is quite fascinating.
Thank you. It was great to talk to you. And
All right.
I hope I could provide some more insights into what I've done, what I'm doing for research.